You're listening to TIMESTAND the Theory.
Hi everyone. Today we are going to talk about marginal cost and marginal revenue. The marginal cost of production, MC, is the change in the total cost that arises when there is a change in the quantity produced. In calculus terms, if the total cost function is given, the marginal cost of a firm is calculated by taking the first derivative with respect to the quantity. The marginal revenue is the change in the total revenue that arises when there is a change in the quantity produced. The total revenue is found by multiplying the price of one unit sold by the total quantity sold. For example, if the price of a good is $10 and a monopolist sells 100 units of a product per day, its total revenue is $1,000. The marginal revenue, Mr., of producing 101 units per day is $10. With 101 units produced and sold, the total revenue per day increases from $1,000 to $1,010. The marginal revenue of a firm is also calculated by taking the first derivative of the total revenue equation. Marginal cost of production. Production costs include every expense associated with making a good or service. They are broken down into two segments: fixed costs and variable costs. Fixed costs are the relatively stable, ongoing costs of operating a business that are not dependent on production levels. They include general overhead expenses such as salaries and wages, building rental payments, or utility costs. Variable costs, meanwhile, are those directly related to and those that vary with production levels, such as the cost of materials used in production or the cost of operating machinery in the process of production. Total production costs include all the expenses of producing products at current levels. As an example, a company that makes 150 widgets has production costs for all 150 units it produces. The marginal cost of production is the cost of producing one additional unit. For instance, say the total cost of producing 100 units of a good is $200. The total cost of producing 101 units is $204. The average cost of producing 100 units is $2, or $200 divided by 100. However, the marginal cost for producing unit 101 is $4, or $204 to $200, divided by 101 to 100. Reaching optimum production. At some point, the company reaches its optimum production level, the point at which producing any more units would increase the per-unit production cost. In other words, additional production causes fixed and variable costs to increase. For example, increased production beyond a certain level may involve paying prohibitively high amounts of overtime pay to workers. Alternatively, the maintenance costs for machinery may significantly increase. The marginal costs of production may change as production capacity changes. If, for example, increasing production from 200 to 201 units per day requires a small business to purchase additional equipment, then the marginal cost of production may be very high. In contrast, This expense might be significantly lower if the business is considering an increase from 150 to 151 units using existing equipment. A lower marginal cost of production means that the business is operating with lower fixed costs at a particular production volume. If the marginal cost of production is high, then the cost of increasing production volume is also high, and increasing production may not be in the business's best interests. Marginal revenue. Marginal revenue measures the change in the revenue when one additional unit of a product is sold. Assume that a company sells widgets for unit sales of $10, sells an average of 10 widgets a month, and earns $100 over that time frame. Widgets become very popular, and the same company can now sell 11 widgets for $10 each for a monthly revenue of $110. Therefore, the marginal revenue for the 11th widget is $10. For example, suppose the price of a product is $10 and a company produces 20 units per day. The total revenue is calculated by multiplying the price by the quantity produced. In this case, the total revenue is $200, or $10 by 20. The total revenue from producing 21 units is $205. The marginal revenue is calculated as $5, or $205 to $200. Divided by 21 to 20. How can marginal revenue increase? Marginal revenue increases whenever the revenue received from producing one additional unit of a good grows faster, or shrinks more slowly, than its marginal cost of production. Increasing marginal revenue is a sign that the company is producing too little relative to consumer demand, and that there are profit opportunities if production expands. Let's say a company manufactures toy soldiers. After some production, it costs the company $5 in materials and labor to create its 100th toy soldier. That 100th toy soldier sells for $15, meaning the profit for this toy is $10. Now, suppose the 101st toy soldier also costs $5, but this time can sell for $17. The profit for the 101st toy soldier, $12, is greater than the profit for the 100th toy soldier. This is an example of increasing marginal revenue. Balancing the scales of marginal revenue. For any given amount of consumer demand, marginal revenue tends to decrease as production increases. In equilibrium, marginal revenue equals marginal costs. There is no economic profit in equilibrium. Markets never reach equilibrium in the real world. They only tend toward a dynamically changing equilibrium. As in the example above, marginal revenue may increase because consumer demands have shifted and bid up the price of a good or service. It could also be that marginal costs are lower than they were before. Marginal costs decrease whenever the marginal revenue product of labor increases. Workers become more skilled, new production techniques are adopted, or changes in technology and capital goods increase output. For instance, a toy company can sell 15 toys at $10 each. However, if the company sells 16 units, the selling price falls to $9.50 each. The marginal revenue is $2, or 16 by 9.50, 15 x 10, divided by 16 to 15. Suppose the marginal cost is $2, The company maximizes its profit at this point because the marginal revenue is equal to its marginal cost. When marginal revenue is less than the marginal cost of production, a company is producing too much and should decrease its quantity supplied until marginal revenue equals the marginal cost of production. When, on the other hand, the marginal revenue is greater than the marginal cost, the company is not producing enough goods and should increase its output until profit is maximized. Marginal analysis. All these calculations are part of a technique called marginal analysis, which breaks down inputs into measurable units. First developed by economists in the 1870s, it gradually became part of business management, especially in the application of the cost-benefit method, the identification of when marginal revenue is greater than marginal cost, as we've been explaining above. According to the cost-benefit analysis, a company should continue to increase production until marginal revenue is equal to marginal cost. If the optimal output is where the marginal benefit is equal to marginal cost, any other cost is irrelevant. So marginal analysis also tells managers what not to consider when making decisions about future resource allocation. They should ignore average costs, fixed costs, and sunk costs. For example, a toy manufacturer could try to measure and compare the costs of producing one extra toy with the projected revenue from its sale. Suppose that, on average, it has cost the company $10 to make a toy. The average sales price over the same period is $15. This doesn't necessarily mean that more toys should be manufactured, however. If 1,000 toys were previously manufactured, then the company should only consider the cost and benefit of the 1,000th first toy. If it will cost $12.50 to make the 1,000th first toy, but will only sell for $12.49, the company should stop production at 1,000. What is a profit maximizer? In economics, a profit maximizer refers to a firm that produces the exact quantity of goods that optimizes the profits received. Any more produced, and the supply would exceed demand while increasing cost. Any less, and money is left on the table. Manufacturing companies monitor marginal production costs and marginal revenues to determine ideal production levels. The marginal cost of production is calculated whenever productivity levels change. This allows businesses to determine a profit margin and make plans for becoming more competitive to improve profitability. The best entrepreneurs and business leaders understand, anticipate, and react quickly to changes in marginal revenues and costs. This is an important component in corporate governance and revenue cycle management. If this knowledge benefits you, please subscribe and hit the notification bell for the next knowledge. Thank you and see you in class.